How we doing, everybody? Get us in here. Realize I was getting posted nice and early today. Nice. There you go, Kev. Sick. Yeah, we had a good morning. We had all kinds of fun stuff. We got this we got this short on IWM. Yeah, there you go, Kev. Love to hear that. We got this short on IWM. I think we shorted it here and then took the reshort here. Did two nice ones there. Um, we took some spy calls somewhere. That was like my first spy trade. Wow. We took some spy calls somewhere down here. We got nice pay on those, 50% or something on those. It's a good day, fun day for trading. I love this. Well, I hate the early knife unless you're part of it, and we're lucky enough to be part of it on IWM. But dude, nice couple few buck range on SPY is so fun. Yeah, Ford worked nice for me. The ad on Ford. Unfortunately, shorted it here yesterday, but then got two nice trends working. So had to try the reshort out there. And then the average down paid big. Took it right to where I wanted it to, even. Yeah, exactly. Avenger, part of the plan. Part of the plan. We wanted it. We wanted to be down 35% the day after we opened for sure. But it was just a reasonable enough. That was even, I mean, I would typically not tell people to average down, but I'll tell you, I'll add on that. I happily would have stopped over that trend. So that's a reasonable enough place to say or to, add a little bit to it. Dude, Oscar Hunt made a, whoa, it was like right here. Dude, it was so low when we were talking about it. Netflix, yeah, finally. We've been talking about that for months that it's that deal, like I am like not in there yet. Happy that I wasn't in there yet, apparently. Um, but it's that deal, just kept waiting for that deal, just bad news after bad news and working, gonna not work, no, who knows? And then so finally get that deal out of the way and what are we at? We're trading 95, 90, 93. Nice, that's a gap. Right back to where I wasn't in there yet. 1177 on Oscar. Oh, from that ad? You at from that morning? I mean, I knew it was down here somewhere, but wow, we were on it, huh? It's a good one. Welcome, everybody. We'll give it a few more minutes here. Yeah, yeah, massive regret on this. Dude, but the XLFs are what is killing me too. This was my entry. We put a blue circle. This is even given in voice chat. I don't think anybody took it. But that was my entry, and I cashed them right here that next day. Husky, how we doing? Your attendance been just perfect lately. Love to see it. Nice. There you go, Kev. I got in 5150s for 12 bucks. Yeah, I don't pay attention to those things. Didn't they have like a news thing or something today? I thought I saw someone mention something. No, I guess not. Oh, just their earnings, their challenging quarter went to running. Yeah, well, dude, nobody's got the attendance of we're your mom's cardio tonight. Burnt peanut. I don't know. Burnt Peanuts missed a lecture of mine in 5 years or years. It's one of the few people still around that I talked to before I worked for T. Yeah, that works. Stop. Dude, he sends me like pictures of himself in the work truck at the job site with the iPad out trading. Dude, this guy's too much. He's from the Lowe's parking lot. He's stealing Wi-Fi from Lowe's to trade. Yeah, I like this. I like XLF. XLE is tough. I don't know, man. Things just been, but I will say, uh, um, long consolidation leads to big breakouts. We've seen it on a couple of those oil names, but man, I don't know if this is ready for this breakout just yet. We'll see what happens to it, but yeah, and that obviously sent us flying, which is like still trying to figure that out. We have all this oil, why that we didn't have before. Trying to figure out why oil prices are up 20% since we started getting more oil. It's got me confused. I'll never understand the oil market. I wish I did. Nice. There you go. Yeah, low 40s. I like it. And I mean, you can like I said, obviously you buy down there, treat it as a trade. We obviously got the big breakout this time. Like again, like I said, I'll never fully understand the oil trade or anything like that. But nice work on that one. Okay, give me one more second. Okay, and welcome everybody. Happy to have you here, Dirty River. Tonight, we are going to be talking technical analysis and price action. Going to be, definitely, obviously, very technical lecture tonight, really focused on charts, focusing on things to look for on charts. And then we're going to get into how to actually trade them. For the last couple of weeks, few weeks, we've been learning how to identify things in the market. An interesting thing that every trader deals with is, when they start trading, they want all the indicators, they want everything, and they want all this stuff on their charts and their RSIs and their MACDs and all these things that, they think, oh, this is going to give me like, my best trading. And every single trader over time uses less and less. So that's what I think all people should work for. You guys know I use a few indicators. I think having a few indicators on your charts, generally speaking, is beneficial. There's times and places that they're going to help you out. There's times and places that they aren't going to help you out at all. But a couple of indicators can be helpful. However, less is often more. And so that was why when I started doing these lectures that we're doing now, I wanted to focus just on identification more than anything else, identifying trends, identifying range markets, starting to talk a little bit about price action and, bullish versus bearish candles and what those things can kind of tell us in the market. And looking at overall blank charts like we kind of have been for the last couple of weeks. We've been looking at charts as simply as possible, and so tonight we're going to get a little bit more into the actual charting side of these things. To me, this is essential technical analysis that everybody needs to know. I know that I was just talking about like less is more on your charts. You will find very few people that are successful that don't use some kind of technical analysis. To me, technical analysis is definitely, uh, it's a bit of a double-edged sword. There's some people out there who really, don't like it. So a lot of those people are fundamental investors. Fundamental investors have just been having a rough go, they for decades now. It's the days of trading your PE ratios and things like that are really just kind of gone. Um, because we have computers involved. And so you really need to, um, you know, you need to get some sort of technical analysis involved in your charts. And I'm going to tell you right now, you don't, you will find very few traders that don't have something on their charts that are successful. Whether you call it support and resistance, whether you call it supply and demand, whether you call it buy zones or sell zones or whatever you call it, you will find more success using a bit of technical analysis. There's a book. I mean, I recommend it. It's thick though. It's Technical Analysis of Financial Markets. It's by John Murphy. And he was one of the, he's they call him the Godfather of technical analysis, things like that. He knows everything, and he was one of the original people doing technical analysis. And even in his book, he starts, you taking fundamentals into account for investments is, definitely a good idea. Your longer term kind of things. But even he starts his book, the Bible of technical analysis with, the days of being strictly a fundamental investor are dead. You need some technical analysis. And the best ways we can do it are, support and resistance and trends. I know there's a lot of people out there that will, disagree with this or say that they don't think trends work or blah, blah, blah. It all depends how you look at these things. And that's what we're going to get into a little bit tonight is how do I look at trends? How do I look at support and resistance? What are some very easy charting things that literally anybody can do? And then ultimately start to place some trades or at least, have a better understanding of the market and have, actually have some thesis behind your trades and not just say, don't be the person on trade for like, oh, $50 out of the money Tesla calls for next month based on nothing. Don't be that person. Be able to identify these places on the charts where maybe you want to be a buyer or maybe you want to be a seller. And once you have those identified, something that I always try to teach people is a very big part of being a trader, especially being a good trader, is doing nothing. Sit there and let the trades come to you. We see it all the time, not just members, some alerts, people want to rush into things that are running as opposed to just waiting for a nice pullback, and then we'll see things like I heard it all day today, obviously Nvidia earnings last night. Huge deal for the market. Very, very good earnings. You'd kind of have to be an idiot, no offense to anybody, to think that they wouldn't put up very good earnings. However, Nvidia sells after earnings. I mean, for years now, Nvidia sells after earnings. We can buy the dip, a day, two, a week later, whatever it is, and ultimately make some nice money on it. But Nvidia sells after earnings. Back 2022 when it was putting out those mind-blowing earnings things, the first like, oh wow, Nvidia is changing the world earnings, obviously was going to explode on those. They guide so high, and of course they beat it. They can't really have those, 100% revenue blowouts, 150% revenue blowouts that they were in 2022 because they guide, in my opinion, honestly, and they guide for what they really think they can do. They, of course, shoot high, but then they come through. Well, today, everybody's bulled up going into the open. Everybody's saying long all tech. Everybody's saying Nvidia saved the market. And ultimately, the market sells all day. And then the people who are long start to make these excuses of, oh, well, my trade was valid, but the market sold. Um, and that's fine. Your trade wasn't valid. Once the market started selling and you wanted it to go up, that kind of removed the validity of your trade. But we see it all the time. And how can we not get ourselves in that position? And how can we, maybe make our losses smaller, maybe make our gains larger? It is some simple technical analysis. So again, after all that yapping, we're going to get into it. We're going to start with, in my opinion, the most important technical analysis that there is, again, support and resistance to me. Are you going to walk into some giant hedge fund and they are going to tell you, the support and resistance levels they're watching? Absolutely not. However, are you going to walk into a hedge fund and they might tell you they have their eyes on a 200 SMA? Absolutely. And that is a form of support or resistance, depending where it is. Well, tonight we're going to focus on levels on the chart, and we're going to focus on actionable levels on the chart. That is what's most important to me. The first part of the charting that we're going to do, we're going to go back in time, we'll say. We're going to go back to 2022 bear market. We're going to chart the 2022 bear market, and then we're going to see how those levels performed through 2023 as the market recovered. And that's going to be our little bit of, proof of what we do works. Then we're going to start doing some charting for recent times. We have such a beautiful range in the market established right now. We have the S&P, IWMs, NASDAQ, all of it is very, very tradable right now. Obvious places to get long, obvious places to get short, and range bound trading is our best friend, especially when they're giving us a 20 buck wide range on SPY. It is like the Christmas gift that keeps on giving. So again, with that, like I said, we're going to start on SPY. We're going to go back to 2022 bear market, and we are going to do some charting. So support and resistance, super simple. You're going to find a bunch of, everybody does it different. I don't want to say everybody does it different, but people have their different ideas of support and resistance. I'm going to teach you how I do it and what I care about when I am charting support and resistance. Something that I want to point out is the levels are good forever. That's what I really want you guys to grab from this. If 350 bounced once, it's probably going to bounce twice. That kind of logic. And so that's why I wanted to go back to a time where we saw a nice downturn in the market and start charting. So we're going to be able to, chart the downturn, and then we're going to be able to use those same levels from the way down for the way up. That kind of proves, that proves to us that this stuff works time and time again. We know that if our levels are good, then we should see a reaction at them. It might not be the reaction we want. Maybe we're shorting the resistance and it breaks the resistance. It's going to happen. Maybe we're longing support and it's going to break that support and go down. It happens. There is no way around it. That's what markets do. They consolidate and they eventually break out. So when we chart support and resistance, we're going to always focus on being as accurate as we can. However, we also need to be aware that it's not going to be to the cent. Don't get me wrong. Every once in a while, you're going to bottom tick, you're going to top tick, you're going to say, look, my level hit to the penny and we rejected or we bounced or whatever we did. That's not going to be the norm. So, just as an example, say we're going to short a bounce to 400. Well, that means if it hits 401, that doesn't mean you stop out. We're shorting 400, looking for a rejection at 400. Maybe it's going to reject at 450 cents. Maybe it's going to reject at 490 cents. We just know we want to be short around that area. And when we're proven wrong, we take the stop out. So Shark described it really, really good to me years ago. I just loved it. He was in a lecture with me and he used this description where he said, when you're charting support and resistance, squint your eyes. Make it so you can't see as good. Are you short in 400? Are you short in 399 and 50 cents? Are you short in 450 cents? None, that doesn't matter. You don't need to be on the penny. You need to be in the area. So you guys have noticed Shark, in one of our last lectures, and him and I are going to do another one because people love those. They like talking to him. He uses supply and demand zones. He doesn't really even use supply and demand zones. It's, his support and resistance, charted a little different than some of the supply and demand guys do. But his way of looking at zones is his way of naturally squinting his eyes. He's saying my zone is 400 to 494. That's where I want to be short. When we're outside of there, great. It's not 400 on the dot. It's that nice little range. So when we chart support and resistance, we're trying to be as accurate as we can. But what is more important is that we are in the area of where a large move happened. That's something that I always try to point out to people and something that I talk about a lot. Because I do voice chat, and Nando deals with the same thing. We get asked it all the time. Calls or puts? Question mark. Oh, should we get SPY calls here? Should we get SPY puts here? People think every candle of the day is providing you an entry, and it's not. The market needs to be somewhere for us to do something. And because most of us trade options, we generally speaking, and swing traders deal with a little bit more. Uh, Swing traders have to deal with it a little bit more, but we want time in our favor. We need a move to come fast. Maybe it's 5 minutes, maybe it's a day, it depends on the trade, but we want to put on trades where, you know, we expect a large move in a timely manner. Otherwise, the trade is likely not that ideal for an option trade because we want, volatility in our direction in a timely manner. If we don't think that's going to happen, if we're in the middle of ranges, if we're trying to buy middles of consolidations, things like that, that's probably not where we want to be entering. We want to be entering at the places where big moves happen. So I'm going to show you how I identify those on the chart. Again, nothing is 100% in trading. If it was 100%, everybody would be rich and this would be super easy. We just want to identify these places where something has happened before. So let's see if something can happen again. So if we don't have any questions, nothing, we'll get rolling on some charting. Avenger does mean in there rather than for exact level increase your risk. Yeah, of course. Yes. So you're talking about, I was just using this 400 example. Yes, of course it's going to increase your risk, but that's part of your trade plan. Say you want to be short at this 400. Well, do you want to wait for 400 on the dot? Or do you want to put on a little extra risk and risk that bounce up a little bit? Or do you want to wait for this, 401 test and ultimately miss the trade? Does it add a little bit of risk? Absolutely, but it's still very defined risk. So while it may be a little bit more risk, your risk is still 100% defined because you might have a zone, and you just want to be short in here. No matter what, your top is your maximum risk. So if you're buying at the low of the zone looking for a short, then you're increasing your risk. The closer and closer you get, the lower you reduce your risk and increase your potential reward. And I teach all the time, most people would find a lot of benefit in waiting for buying until it's close to their stop loss. People have an unbelievable ability to like rush in, and maybe they're going to short 398.99 because they want to be short at 400, but they don't want to wait for that dollar bounce. Well, if your stop loss is 440, you want to wait and wait and wait as much as you can until that stop loss level shows up. And that's where you buy because you're going to reduce your risk the most and you're going to increase your potential reward the most. But regardless of if it's a zone or whatever it is, your risk is defined. And to me, that is really the most important part. So I see next question. For day trading, what's the best time frame to look at? So I'm gonna get into that in just a second. Excellent question. Slow grind tends to cook me. Sorry, I'm reading this. Slow grind tends to like, be a tricky form. Yeah. Well, and slow grinds suck for anybody that is uh trading same days, even one DTEs. One DTEs do give you a little bit, but still holding through like, $1 consolidation for an hour sucks, even on a one DTE. So slow grinds you will always hate in short expiration contracts. That's just the way it's going to be. We see it all the time where, maybe SPY contracts are expensive, VIX is up, whatever it is, and we'll get a nice little move, but it takes so long that we've made no money. So that's again brings us back to we want to be not buying in those times. We want to be uninvolved in those times. And if we are involved in, slow grinds or consolidations, we want to be buying low and selling high during that consolidation. And then if we're lucky, we get to be in the trade when the breakout finally comes. But slow grind up and slow grind down, no way around it. It's going to hurt your contracts a little bit. One case. So, uh, difficult question. Depends on the setup. Um, a lot of the time, I'm waiting for a candle to close. There's times, there's some certain trades we obviously aren't going to get in this thing. You'll know what I'm talking about, but uh, I love three push wedges. I especially love a three push wedge that breaks the wedge under it. I'm not waiting for that candle to close. I'm looking for the volatility down. I'm going to look for something else, volume, zeroing out, whatever it might be, B-band, something like that. And I'm buying that candle on the way down for it to go up because I like that trade. But 9 times out of 10, I want a candle to close or I want to be in there shortly before the candle closes. I because I want the volatility, So we might buy 30 seconds before the candle closes. You guys hear me in voice chat all the time. I do watch the candle clock just because things happen, when those 5 minutes close, when those 15 minutes close, when those hourlies close, uh, you know, something happens there. I don't know what it is, but market loves a little bit of volatility right as candles open. So I will do that. Again, just as another example, because I like the question, a double top. I'm oftentimes going to buy that double top before that candle's closing. I'm going to buy it when it hits because I'm oftentimes going to be looking for a scalp. Of course, double tops or bottoms will oftentimes provide a reversal. If it's going to happen, that's where it's probably going to happen. But the consistency of it working of when you hit that double top and it might wick down and pay you 20-25% and you can sell and it might wick all the way back up and break out the 20 and break out the double top all in the same candle. But there's times where I'm buying when the thing sets up, or if I'm looking for a real trade, a better bounce trade, I'm going to be looking for some consolidation, looking for multiple candles to be closing above or below a level, and then I'm going to be buying or selling that, whatever it might be. Um, okay, so so tricky question. Here's the deal. And this person is asking about you know, what's the difference between saying, "Hey, I'm wrong," and saying, or being like, "Oh, you got to let it work," and being patient. I commend Nando for his patience a lot. I'm a very patient trader as well. I'm a very patient trader when it comes to entry. I want X, Y, and Z lining up for my entry. Some of those things that I was just talking about. My stop loss, I'm impatient. There's a reason you go through my spreadsheet and our stop loss is average 15% because and we're going to get in a little bit to this, because of how I trade and because of where I buy and because of where I like short, sell, whatever it is, I'm right or wrong right there. This kind of goes back to waiting for the area where your stop loss to be to enter can be helpful because I want to be entering trades where I expect volatility quickly. And you want to keep your losses small. A loss should always be kept small. You take a 50% loss on a trade, that's going to take you multiple trades to make up. So I don't ever want to land in that situation. I want to be short in 400 and I want to be stopped out over 401. No questions asked. I'm wrong. And then look for a better entry. Part of that comes back to if your trade is down 50%, you now need 100% return just to be break even. You buy at 100 and it drops to 50, you now need 50 to double just to get you break even. It's very unrealistic. So that's why I like to enter where my stop is the tightest. And that's scalps, day trades, all of it. We want to enter and be right or wrong as quickly as possible. And I will say, Nando is patient. He also knows where his stop out is. And I deal with it too, doing VCs every day, just like him. And people saying, "Are we stopping? Are we stopping? Are you still in? Are we stopping? Are you still in?" It gets old. He knows where he wants to stop. And what most traders need to work on is when you enter a trade, anything that happens between stopping out and taking profit is noise. None of it matters. You know where your stop is, you know where your take profit is. Until one of those hits, you don't do anything with the trade. Do I moving to stop on a running candle like we had on IWM today? So on IWM today, we can just talk about this. So we caught, this sell, I trimmed. This thing dumped. When I'm up 80% or whatever, 70%, I just trail that stop up tight and I move on with it. You're gonna pay me 80% in 10 minutes. I'm taking it. I, you know, the issue is this is often met with this. And so when people look for more, look for more, look for more, they end up giving it all back. That's not me. That's not how I trade. Okay, so with that, great questions, everybody. Love it. Let's do some charting. We're gonna, as I said, go back in time a little bit. We'll cruise right through this. So when I am charting support and resistance, we're doing the basics today. We're not getting into the fine little details, things that maybe you'll learn to like. We're going to talk about, as you do this more and more, you will develop things that you like as well. I'm going to show you what I like and what I think is most important of the world of support and resistance. And so when I am charting support and resistance, a couple things that I always think about. I want a level on a wick. I don't want body closes. I don't want opens. I don't want closes. I'm not going to say, yesterday's open or close isn't important. They are in a different way. But these are levels. We want levels on the chart where the market has made big decisions, and this goes back to what I was saying. We want to enter at points of volatility. So we want to identify those points of volatility. And to wrap this back around to the person who was asking, I forget who it was now, but what's the best? I think it was Annie, but I'm not sure. What's the best time frame for day trading? You're charting, regardless if you're scalping, day trading, swing trading, I don't care what it is. A majority of your charting should be done on the daily time frame, in my opinion. Is there values in 4 hourly levels and 1 hour levels as well? Yes. But the daily time frame tells you the big picture. It tells you where those reactions were made. Sometimes you might go to the 4 hour to see what, because the daily candle doesn't include pre-market and after hours. So 4 hour can be helpful for when you had crazy gaps or volatility in the after hours. But for the most part, this is what I teach people. You mark wicks and you mark dramatic highs and lows. What do I mean by a dramatic high and low? Where the market turned around. And so we can just start right here. I'm going to show you exactly how I chart. And generally, what I do is I'll do the top side and you'll see what I mean by this. And then I'll come back and I'll do the bottom side. So, what do I mean by a dramatic high or low? Well, we can see right here, 474, obviously these levels, we don't need to worry about these levels because we're so far away, but 474 was the turnaround point where we sold down to 448.75. I'm not saying it's this level, there was likely news, blah, 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 but this is a dramatic high down to a dramatic low. So we want to be aware of where those started. Something like this, 470 and we drop down to 465. It's $5. Who cares? That doesn't mean anything. However, right up here, we get another level, 473.23, and we sell back down. We want these dramatic moves. Right up here, we can see this little area, again, don't know what it is. Don't really care about what these levels are. We just want to go through the process of identifying them. We hit right here and we ultimately sold way down. This is what we do. You can see we don't have to chart this level. Should be no surprise to anybody. Was huge before, will be huge again. So we just work down the top side and we want to look for anywhere a dramatic move happened. And like I said, we just work down the top and we work down the top. And anytime we see a big old bounce, 429, couple days later, we're down, way down to 385. We want to see where that started. So we work this whole top side down. If we can see it's a little consolidation, we put two lines and we know zones are big. Zones matter. They give us very defined trades, and we know where we don't want to be long. And if we do get above it, we do want to be long. Then we keep working. When I see something like this, my wick above it, I love it. Anytime I can have two levels in a zone like this is what I love. So we just continue to work down this top side. Anywhere we see dramatic highs going down to dramatic lows. And we just work the whole top side up. And that's all I care about. Now we go to the downside, and you'll see we won't have to add too many levels because where do we bounce? Well, we already have this level from somewhere else. We go up to, so we don't have to add anything. We already have this level. We already have this level. This I would honestly make a little argument that that's probably worth noting. But we don't care. We see big cluster of levels. We expect it to have trouble with those. When we come down, we're always creating zones if we can. Zones are where markets move. That's what we care about. Dramatic low gets set, moves to the highs we already have. New dramatic low down here. We basically already got these levels. We could even make that one a little zone. This is all we do. We go through the downsides, got those, got those, got those. That simple. Does everybody see what I'm doing here? Dramatic highs and lows. Somebody might look at this and say, hey, your chart is crowded. We got 25 levels in $130 range on SPY. That is not crowded. If we zoom in, we can see here's a $40 range on SPY, and we got 4 or 5 levels in there. These are, ooh, look at that one that we missed. These are our major highs and lows. These are what most people, when learning technical analysis, should focus on. One of the, wonderful things about technical analysis is that it is the easiest thing you can do to backtest. So again, we have all of our major highs marked. We have all of our major lows marked. I know I might have missed one. Now we get to test it and we get to see how it works. So we start going forward. We know, and I'll put a thing here so we can be aware, every single one of our levels came before this blue circle. So as we start looking forward, what do I mean by it's easy to backtest? Well, we just want to zoom into these charts a little bit and say, okay, are our levels working? Are we pulling back and bouncing around them? Are we hitting these levels and bouncing? Are we finding consolidations at the zones? When we break above a zone, do we move to the next? When we break above the next zone, do we move to the next? When we pull back, do we consolidate at them? This is what we want to see. So you guys can see right here, it's very easy. I should honestly just get rid of my indicators too. Give me a second. It's very easy to see on these charts that we get reactions at these candles. Are they sometimes to the cent a year later? Absolutely. Are they sometimes going to give you a little breakdown into your zone, but ultimately buy back up? Absolutely. Are they going to be really close sometimes? Yes. So you can use, all of these levels are from previous. So we get to see how they work, and we get to see how, when we break zones, do we go to next zones? That's what we want to see. If we aren't seeing any reactions at these levels or at these zones, then they probably don't need to be on the chart. That's the most important thing, is only use these when they're working. Like I said, these levels should live on your charts forever. They will work time and time again. They will tell you where to buy dips. As we've been discussing in, our last few classes, ranges and trends. Those are the only two things that a market can do. So we look for them. We have our levels defined. Well, we get a sell down to here, and then we get a bounce up. We're now assuming that we have a range right here. And we've identified it in a week. Where was our low? Where was our high? Well, we know this is starting to get into a little bit how we trade these. We know dipping into this zone, dipping into the low of range, we want to be long at lows of ranges and we want to have our defined stops. So we're buying our 402.50s to 405s and we're looking for that move to 415 back to the top of the range. And we trade this range until we get a breakout. When we get confirmations of these breakouts, multiple days, many candles closing above, retesting the top of our range, we start to look for breakouts. So you can see we chart our range here. We get our range defined, then we start to break out. And the next thing the market does is it trends. After we consolidate, we trend. So we look for the beginning of our trend. It's going to be somewhere around here. And we trade this trend line up. We know the breakout has come. We know the breakout is confirmed. We stay looking as dip buyers. We break above zones. We start looking for next zones. Sometimes you aren't going to get there. Sometimes you're going to break your trend down, but we look for our higher lows to start developing and we start buying these dips on the way up. When we're consolidating, we short rips and we buy dips. And this is how you trade all day, every day. You look for consolidation. You look to catch a trend. You look for consolidation. Sometimes you get long consolidation. Sometimes your consolidation turns into massively long consolidation here. And here's our low, here's our high. We know where we want to be dip buyers. We know where we want to start looking short, and then we know where we want to stop out of longs. Like we're going to get stopped out of longs if we buy this dip, and that's fine. But we start to look at the market, say, okay, what is the market doing? Well, here's our high, here's a lower high, here's a lower high. We have a downtrend developing because we know markets always go from ranges to trends. So we're shorting these bounces. We're getting bounces up to the trends. We're shorting these bounces until we get proven otherwise. And that is all we do. And you can see, I should have been pointing this out the whole time, levels from at this point, we're into the middle of 2023, levels still working time and time again. And these are, over a year later from when these were formed. You start to break trends, you start to look for next ranges. You break above zones. You break above zones, you look for next zones. Break above zones, look for next zones. Always, always, always trading like that. And so you can see if we take the big zoomed out picture, all of our levels from here traded this upside perfectly for us going into the next year. Obviously, previous all-time highs met with some pullbacks. So this is how you chart. Doesn't matter what you're doing, how you're doing it. This is how you want to trade. You always want to look for consolidations. You always want to look for trends, and you always want to be trying to enter at the major highs and lows. We do that to reduce our risk and maximize our reward. So in today's market, the S&P has gone nowhere. We're going to do the same thing. We're going to look for our major lows. We're going to look for our major highs. Look for any major highs that we have, work our ways up. And then we can look on the lows down here. And call that one, call that one, call that one. So here's our levels. And now we look at the S&P and we say, okay, where is our major range that we have right here? And this is what the S&P has been doing. It has been going straight sideways. If you're buying, you guys have all heard me since, November of last year, as we're pushing up into 694, 695, every single one of you has heard me say, I'm not long up here. You have heard me say it time and time and time again. We start pushing down to our 680s, 675 to 683. We buy, we don't sell. Anybody who trades in VC with me, how many times recently have you heard me say, I'm not long at these highs. I won't short it down here in the hole. Those are the two most common things I have been telling people for months now. And it's worked very, very well for us. And so that's what we do. When we have a range bound market, we want to identify that range and we want to be looking to long down here. We want to be looking to short up here. We also want to take this into our intraday timeframes where we can say, we know the market is ranging. So we want to look for range bound movement in the market. And ultimately, that is what we have had constantly. People keep getting caught off guard, every single day. Oh, we dumped. Why are we bouncing? Because when the market is in a range big picture, it's going to remain range bound and do range bound activities. We get down to the lows of the major range, we buy it. And we start to get up to those highs of the major range. You do not want to be long up here. You want to be short. Same as intraday. Big old pops, don't chase them. Look for doubles and triple tops to form and look for the sells and the dips to buy. We treat big picture same as the intraday stuff. You can see I'm just zooming in to show you the daily levels. They are where your reactions are going to come. Are they going to be to the cent? No. Sometimes they're going to break a little bit above it. Sometimes they're going to consolidate 60 cents below it. But this is what we're going to see time and time again in the market. We want to see breaks aboves and retests. We want to see three push wedges up to get short. The market is sideways, so we treat it as sideways. Big pushes up, double tops, we short them. Big pushes down, double bottoms, we buy them. Keep it simple. Don't be the person chasing the moves up. Don't be the person chasing the moves down. We break a level, look for the move to the next level. We can't break above a level, look for the moves down. What we want to see is our levels working over and over and over again. And as you can see here, these levels that we charted in all of 30 seconds have provided very safe trades every single day. So that's the last spot on this. Ran long. We're going to do another one of these. That's the last thing that I'm going to talk about really on support and resistance is in simplest terms. When we break a level, we want to look for the move to the next level. That's it. We break a level, we want to look for the move to the next level. We get asked all the time about holding runners and this, that, and the other. Don't do it. Look for point A to point B movement. We double bottom at a level, look for a move back to our level. That's all we care about. We want to keep this as simple as possible. Is it always going to hit to the cent? We got 679.30. Well, 680, big psychological number. You basically have to be a buyer there. You basically have to be a buyer here. We know it matters. Double bottoms from the days before, just keep it very, very simple. Just keep it very, very simple and you will find so much more success. Don't be the person buying calls up here saying, oh, I'm looking for the breakout. You know, 80% of the time, the breakout's not coming, statistically speaking. So look for the setup that says, well, I can look for the breakout here to catch my 30-cent move to the upside, 50-cent move to the upside, or I can short here with the 50-cent stop looking for a $4 move to the downside. I know which trade I'm going to take. I also know most people in OOT, they're going to be buying. They're going to be taking the long. While we're going to be looking short, most people in here are going to be taking the long, looking for the breakout. They're likely going to do the same thing right here when this is really the reaction you should expect. Sure, maybe you get the break for 50 cents upside, but wouldn't it make more sense to be short here, 50 cents upside, looking for multiple dollars of downside? That's how we need to analyze the market when it comes to support and resistance and, these zones or whatever you want to call them. Trade these levels. Please, I encourage every one of you, go chart tonight or tomorrow and DM me a chart. You will start finding so much more success when trading like this. So the last thing that I want to touch on, because it was discussed a little bit earlier, and I loved the question about patience. when do you say you're wrong? Um, that is going to be a different answer for everybody. As I said, I want to be right or wrong quickly. So we want to let the market kind of tell us what to do. Um, Maybe we were short. Great, big sell down. Awesome. Well, we get down to here, we bounce. You got to stop out of your short. No questions asked. Well, maybe we come down here and we want to buy our 685.35 level. So actually, I'm looking at this. This is a better example than I would have hoped. Well, we want to buy our level. Maybe we buy it right here. We buy just that first touch of it. Well, we know this is our stop down here. Um, this is one of those examples where same days hurt you. Your trade is valid. You need to be patient here. Your stop's the break of the true double bottom. That is your stop loss. Your contract that you bought right here is red right here. After doing nothing for 45 minutes, some ups and downs, you've had some gamma swings, you've had a little bit of theta, tiny amount of theta kick in there. This is going to be rough for a same day. But I'm going to be patient for it because I know this is where my double bottom is. I'm going to be patient for this trade. Where you need to stop being patient is you get under here. You start getting under here, you start selling more. Oh, it's a liquidity grab or whatever, bullshit people say. Sorry. It's a liquidity grab nonsense and oh, it's going to bounce back up and we're good. Well, maybe, maybe not. But as far as I'm concerned, your trade plan is wrong. And when you haven't stopped out on candle closes under this double bottom, then you're not following your plan. And when the plan goes against you, you can blame VIX, you can blame a market wide sell off, you can blame whatever you want. However, the only person and thing to blame in this whole equation is you for holding past your stop loss. So that's why for me, I mean, on this trade, I might buy this honestly, and then I'll scalp out of it. And then, I'll take my money on my, buck pop or whatever it is, 60-cent pop. And then this candle is likely going to stop me out, And does it bounce right after that? Sure, but I don't care because if we are able to reclaim up here, I'll buy it again. And I would rather do that, have my stop be 12% as opposed to hold all the way down to the double bottom. Because if we happen to, we get down to here, I'll buy the double bottom again with a tight stop again. That is going to help you in the long run. There's many math factors we have to, think about in trading, risk rewards, win rates, all of that stuff, and a million different views on it. But I will tell you right now, if you reduce your risk and try to maximize your win rate, you are going to have a substantially easier time making money in the market. There's a guy I love. He's, in my opinion, one of the best supply and demand traders out there, that Carmine Rosado or Rosanto or whatever. Dude, he's unbelievable. His win rate is like 40%, 30%. However, he takes extremely low risk, extremely high reward trades. He also takes very few trades. Uh, and he makes money. The average person, you're running a 50% win rate with big stops, you're never going to make money. When you need, when you need gigantic wins to cover 10 losses, you aren't going to last long in this market. So for me, we want to minimize those stops and we want to maximize that reward. So on a trade like this, let's pretend that we aren't me, okay? And let's pretend that we're 1K. He's super responsible, 1K, he trades his 1 DTEs. So here's our daily level. We know that sometimes we get pokes under daily levels and we buy back over the top of it. We can see our selling coming down. We can be saying to ourselves this whole time, I'm going to buy. I'm going to buy this level. So we know where we're buying. So maybe we buy the breakdown, the reclaim, and the retest. We know where we're buying. The stop is here. the reason the stop is here is we're not only breaking a double bottom, which, and it's not just that level, it's a break below that level. So realistically, here's our double bottom. Our stop's got to be a little below there because we can't just stop hard right there. We have to see what happens, let a candle close, whatever it might be. It might just be a knife down and you get stopped on the candle close and it rips against you. That's going to happen sometimes. But this is our entry. We know our stop is a break below here. On a 1 DTE, there's nothing. Our target's here. Our stop is here. Anything that happens between here and here does not matter to us. If we have that little bit of extra time, it doesn't matter. However, if we are on a 0 DTE, like I said, this chop makes it harder to make money. Ultimately, this candle is going to pay you really nice, but if you held through this, you had a bad time, especially when you're buying a downtrend that hasn't broken yet, blah, blah, blah. Ultimately, this one did break and run. But you this one you could easily get stopped out of early, even though you're on your 0 DTEs, even though your stop is down here, strictly due to time, because we are fighting time. And we don't want to depend on the out of nowhere buck 50 God candle because we have kamikaze drones now. We don't want to depend on that. We want to let the market tell us we're turning around. So stopping out early is kind of a double-edged sword. Stopping out for a smaller loss and looking for re-entry is always a much better way to look at your trades, at least in my opinion. Let's see. So that's all I got. Let's get some questions. We're basically going to do a similar lecture. We got to support and resistance. We got more to talk about. So, how do you trade a stock when it's running at all-time high or all-time low? Well, all-time low, you look for a reason to buy and let the market tell you to buy. Big old daily double bottoms, things like that. What's one that I just saw? Oh, Oscar. So, Oscar, it's not all-time lows, but um so we can go, let's see, let's just do a new one here. So Oscar, one day, go 5 years. Um, so when we look at Oscar, gigantic range, we know that, but big old range. This is basically our range. Well, we want to do the same thing that we did. We want to chart our major highs, you know, this stuff. And then we want to chart our major lows. Where does the market take big old bounces? And so we're going to look at something like this, and we're going to look at this chart, and we are going to say, I'm going to buy at $12. This is horrible because I said this and I didn't do it. You buy at 12 and you stop at 11. It's worked for 3 years. When it shows up, it works. So you buy here. You don't want to be the hero catching the knife. No, this is one. IBM exploded. Did I want to catch the knife? Sure. Did I think this was a strong level? Sure. But it wasn't enough for me to want to buy it yet. It's not major enough for me to be rushing in there. So I want some major lows being set when I'm really looking for a dip buy. Any all-time low thing. I mean, my favorite one ever. Here, I'll show you. I'll show you. Let's see. Um, this is my favorite dip buy that I will ever have done. So we got to cruise on back to let's see. We're still going. So we have cruised back now to the year 2000. Some of you guys probably weren't even born yet to snipe our 14 little zone down here. And then we're going to cruise all the way back. And where are we buying T? We're buying T at 14 because this is a pushing 2 decade long double bottom to form. We're buying at 14. That's how we buy at all-time lows. You let a true knife happen and you buy it. That's going to be your best way. And then I see 1K, he responded to you. The easiest way to trade once we start pushing all-time highs, new all-time highs, is FIBS. Oh, actually, I got a great example of this. XOM. So right here, You guys can go back and find our class from the beginning of January. Nando joined me on it. We were talking XOM right here, and he said to me, "Well, what should we be looking for?" And like what should targets be? This is a 4-year consolidation on XOM. So we run some fib extensions here. I guess I see people asking about it. So we run some fib extensions. We're gonna go, dude, what is that? Okay, I got no idea what that thing on my chart is. Um, so doesn't matter. Here's our range. We got our highs, we got our lows. Now we want to go for fib extensions. These aren't fib retracements. So we want to identify our low, and then we want to identify our high. So where a fib extension is going to change a little bit, and you can see, you notice that I didn't pick these highs because this range was formed a year before that showed up. That's a failed breakout as far as I'm concerned, right here and right here. This is our real range. So fib extensions are a little bit different. We go from our low to our high, but now you're seeing I'm given a midpoint. Well, it's up to you if you want to use it. For me, I am oftentimes going to use a midpoint. And the midpoint I'm going to use is just going to be the middle of the range. I'm estimating what this is, but I'm estimating the middle of the range. This is how I'm going to use fib extensions. Or if you don't want to do it that way, and this is what I showed Nando, you're just going to run those fib extensions because we know this is our range. Here's our fibs for the breakout. Are they going to go like this normally? Absolutely not. This was just a nice geopolitical breakout for this thing where it whacked basically every fib we care about. But those are going to be the easiest way to trade fibs. Damn. Thanks, Rel. That's actually super fucking nice of you. Okay, so I think I got your question there, Fancy, about stop losses. Oh, so okay, love that you said that because I didn't see that second part about it. So on this trade right here, there is exactly zero question for me personally that as close to this level as you can buy is better. As close as you can get to this level is better. And why? Reducing risk, maximizing reward. The closer you can buy to your level, your stop out level, I should say, the less risk you have. So that is always going to be good. What do I use as a sign to re-enter? Well, we were going to start talking about like real signs and how to identify, consolidation versus potential breakdowns. We didn't get to it. That's going to be the next lecture. But reversal candles with retests off of higher lows, that's my go-to. You've seen my drawing. This is literally my joke drawing that I send. Check IWM, 10:15 a.m., but you're gonna have to give me what time zone is that? Is it this one? Huge sell-off, double bottom, never closed below the double bottom, so I'm hoping you got in there. Oh yeah. So you probably bought the double bottom. I see it right here. Got stopped out. Reasonable. See, they ain't giving this up. Rebuy here. I bet that's what you did. We'll see. Carvana, is it doing something? You loaded more Oscar at 12:12. Nice. Um, IWM. So IWM, 10:15. I didn't know what time you were talking, but I'm assuming you bought this. You got stopped here. You rebought this. And that's money. I would have bought that with you. That's beautiful. I mean, it's perfect. It's perfect if that's what you did. Great job. And I would have got stopped here too, because it's feeling like it's invalidating a short. But maybe you're talking about a different time, but feels like it's invalidating it. Unless you shorted up here. Maybe you shorted this or something and got stopped, or this. Yeah. But again, I don't know what time frame you're in. What exactly is a fib extension? So it's, have you ever read about the Fibonacci sequence? Basically just think of it as like a series of numbers that occur all over the place. Fancy math. for that give you probabilities of something happening. And so that's what fibs are. Kind of woo-woo, work unbelievably. It's just a nice statistic. You can get really deep on them. So for those of you who don't know, I was pretty dang hippie in my youth, so I'm actually pretty dang into Fibonacci stuff. But ignoring that, it's just kind of uh likely probabilities based on ranges to hit something. It's the same idea as a fib extension or a fib retrace. So, you can, you know, you can run retraces as well. Oh, this one, sick. And you shorted this, sick. Yeah, we were short on this one too. We were short on this one too. Probably my time, 10:15. So you might be East Coast time, maybe. This one, sick. Or if it was out here, sick. Yeah, there you go, sick one. So you can do fib extensions. You can also do fib retraces. So you're like, oh, well, this thing bounced. I want to know what 50% of that retrace is. And that's what it's going to show you. It is not going to be exactly half the move. It's actually going to be a little bit different than that. But basically, just think of it as half of the move back down. That's it. And you can do them down or up as well. I'm not a big fib person. I think the time and place for fibs is when you're in no man's land. So just to go back to XOM, and I mean, here's my one this is the one I charted with Nando. Just to go back to XOM, we don't have levels up here. So when using, when we're supporting resistance traders, maybe you are, maybe you aren't. When we're supporting resistance traders, it gives us some levels to target based on MAC. So they're kind of nice. But I've never been a big fib trader myself. It's never been my kind of thing. Um, I like to know exactly why a level is there. And so, that's like, I mean, we can go back to SPY and somebody can say, hey, where'd you get 696.31 from? And I can say January 12th or, whatever day it is. I can tell you on the daily chart where that level came from. And then I can tell you, and I can say, and look at what we did at that level on January 12th and 13th. We got crushed off of it or whatever it is. So that's why I like support and resistance more because I can give you a reason of why I have that level on that chart. And like sometimes they'll show you just sweet little things like this, like that was our low. Then we said this low. So then we knew here a week and a half ago that we hammer this long at 675. Okay, well, everybody, thank you so much. That was actually a really fun class. I loved all the questions. Hopefully I got to everybody's questions. But this one part class turned into part two class. So next week, hopefully I remember that our SPY drawing set was blank and I don't delete it. We'll go through this chart and we'll talk identifying ranges and trends intraday as well as some price action stuff and candles that give us a idea of why to enter. Is this consolidation? Is this potential breakout, breakdown, blah, blah, blah. But thank you, everybody. I really appreciate it. Great questions tonight, and we will catch you all tomorrow for a little Friday fun day. Yep. Thank you, everybody. We'll talk to you soon. You too.